Chapter 6, Cost of Sales and Inventory. So the first part of this chapter, then we're going to talk about how do we come up with the cost of goods sold on the income statement during that accounting period. And secondly, how do I account for inventory? Okay, the cost of goods sold is the inventory that I sold. How do I value the ending inventory? And there are different methods of doing that. Now, to begin with, we have to distinguish between three types of companies. There's the service company, a company that does not handle or sell any kind of inventory. It provides a service, a haircut, barber, beauty shop, so on. Then there's a merchandise company. This is a retail company. Many of you have experienced retail merchandising companies. They sell goods that they have bought. They never manufactured them. They have bought in these goods and they don't change them in any way. They simply put a price tag on them and put them on the shelf. The third category, more complicated, is the manufacturing company. This company buys in raw material, puts it through a conversion process, and converts that raw material to a finished goods. Now, we have some inventory issues now. First of all, what costs comprise cost of inventory? And how do we separate the cost of inventory between the cost of goods sold and the ending inventory? Now, first of all, inventory is an asset and it includes items that are held for sale in the ordinary course of the business. Okay, there's two ways in which we determine. There's a periodic inventory method and perpetual. We'll talk more about them. Right now we want to talk about the measurement of inventories and the costs of sales that are related. First of all, the cash flow assumptions, and we'll talk more about these later. There's four: specific identification and average cost. We will mention, but they're not that important. What's important is the FIFO method, first in, first out, and the LIFO method, that's last in, first out. This should be first, not last. I can't spell. Anyway, you know. F. Okay. Terrible, eh? Anyway, merchandising company. A merchandise company buys in goods and just puts on a price tag. All right. Now, the cost of the goods, before we get to that, manufacturing inventory converts raw material to the finished goods. There's three types of inventories here: materials, work in process, and finished goods. And I'll go over that a little later. Service company doesn't have any inventory. Whatever they do, they have supplies. Now, same with professional services. We must distinguish inventory from supplies. People say, oh, I have a supplies inventory. They mean inventory in the sense that there's a group, a number of these items. We're talking like office supplies, pens and paper and what have you, janitorial supplies, repair parts. Those are not inventory. They may refer to them as inventory supplies or that, but when we in accounting talk about the term inventory, we're talking about goods that we're going to resell. Supplies are not for resale. They're basically used up to produce a product or deliver a product or maintain the operations of a business. In a merchandise company now, when we buy in inventory, of course, the cost of inventory is the invoice cost of what we were invoiced for that inventory. Plus, if the inventory comes from a supplier in another town and we have to pay for the transportation to get that merchandise to our business, then that's part of the cost of inventory. That's called freight in. If there's any other costs, such as packing or unpacking or marking, that too is part of the cost of inventory. Now, reductions in the cost of inventory, if I return or have allowances, just like we had in the last chapter, sales returns and allowances, here we have purchase returns and allowances. So that reduces the cost of my inventory when I return it. And just like in the last chapter when we had sales discounts, here we're taking purchase discounts. When we pay our supplier within 10 days, that discount reduces the cost of my inventory. So inventory is inventory cost plus freight in plus any other miscellaneous costs minus any returns allowance, any discounts. Okay, so that's what we're talking about here. Terminology: When we say purchase, we're talking about when we receive the goods, not when we put the order in. That's when the title to the goods change from the supplier to us. And that's usually at the shipping point. That FOB is free on board shipping point. Relationship of inventory to cost of goods sold. These are just mathematical. Beginning inventory plus net purchases equal goods available for sale. Okay, net purchases equal gross purchases minus purchase returns allowances plus freighting. We already talked about that. Two methods of determinant, periodic and perpetual. Periodic inventory system means that I have to stop the business operations at the end of the accounting period and count the inventory that's left unsold, and then multiply that number of items by what it cost me to purchase those items. So in that way I determine, I have available now my ending inventory. That's what I just determined. I know what the cost of goods sold, well, I'm trying to determine the cost of goods sold. I know that will be equal to the cost of goods available for sale. Now the cost of goods available for sale is the beginning inventory of this year plus all the purchases of inventory I made during this year. Those two comprise the cost of goods available for sale. So to determine my cost of goods sold here, which is what I want to do, I have determined what my ending inventory is, and I have, through my records, can determine what the cost of goods available for sale. Cost of goods sold is simply the difference between those two. Perpetual inventory system. Now, we keep a record, an inventory record on every item in inventory. This is this is what merchandise companies that sell larger ticket items do. I mean, if you're selling cars or refrigerators or computers, there's a serial number for each one of those. So you know from the serial number just what you paid for that item. So you know how much it cost you to buy that item, relate that to the sales. So I have a record, and every time I sell, I have a card for everything I have in inventory. When I sell that inventory item, I take the card out, I know exactly what I paid for it. So I have detailed records of this. And at any time, I can tell how much I have left in ending inventory by looking at the cards I have for all the items that are not sold. So it's very easy to do the income statement if I'm on a perpetual. Now, many retail companies are trying to get to a perpetual method. But you can imagine in a grocery store, there are just so many items. But what they do now is they use barcodes. You've seen those barcodes on the product. That barcode tells them exactly when they purchased that item and what they paid for that item. And so when it's rang through the cash register, you have the selling cost or the selling price, which is the customer is paying, and the barcode tells the computer right away what they paid for that item. So they have the cost of goods sold very easily that way. If you don't do those methods, there's another way, and that is to determine the gross profit percentage or the gross margin percentage, whichever way you want to look at it. You look at the purchase. Okay, you're going to record what I purchased. So I purchased things for 40 dirhams and I sell them for 60. So I mark them up 50%. Then all during the year or what have you, every time I sell, it's the cash register is saying I sold for 60, I sold for 60. Then all I have to do is multiply the gross profit percentage, and I know that the cost of goods sold is 2/3 of 60, which would be 66 2/3%. Same with the gross profit method. Now, more importantly, let's talk about manufacturing companies. Okay, they convert product, raw material, and the conversion cost is the labor and all other manufacturing costs. Convert the raw materials to a finished goods. So there are three types of inventory here: the raw material inventory, the work in process, and the finished goods inventory. That is goods that have not been shipped yet. Now, the pattern, what has been transferred out is equal to the beginning inventory plus what was brought in minus the ending inventory. So materials used is equal to the beginning inventory plus purchases minus ending inventory. Cost of goods manufactured is equal to the beginning inventory plus the materials that were used on the shop floor during this accounting period plus the labor on the factory floor plus the overhead minus the ending inventory, That is the value of the goods not quite completed. Gives me the value of work in process. Finished goods, cost of goods sold is equal to the beginning inventory of finished goods that I had, plus the cost of goods manufactured and transferred to finished goods during the accounting period, minus the ending inventory of finished goods. Gives me the cost of goods sold for that accounting period. Now, product costing, here is a perpetual inventory system because we know exactly what the costs are as it goes across the factory floor. There's a job ticket usually that goes with each product, and on that job ticket they record the material, they record the labor, and the overhead. Now, there's a very important distinction when it comes to costs, and that distinction is for a manufacturing company only. We must distinguish between product costs and period costs. Now, product costs are also called inventoriable costs. These are the costs of the material and the labor and the electricity and the machines and everything that went into the production of the product. These costs are assets. They're not expenses. They don't become expense until they've been sold as finished goods, and they come out on the income statement as the cost of goods sold. That's the only time that they are expensed. Okay. Period costs are costs in a normal course of the business. Marketing costs, selling and admin costs, general and admin costs, all of those are costs that are incurred in the period cost, the cost of the president, the secretary, all of that at the beginning. Transportation of delivery of goods, all of those are period costs. Now, this is an important distinction, and I'm going to go through an example now.
Review a manufacturing plant, a building, okay? We have a building like this. This is our back door, okay? Up here is the front office. The front door. In here is the president, secretary, marketing people, accountants, and so on. Back here is the plant, the manufacturing area. Now, the manufacturing area, what we have here, raw materials or direct materials are delivered to the black door. These wood, laminate, metal, what have you. Out here on the shop floor are different machines that will bend the metal, cut the wood, press the laminate, and so on. And here is an area for the finished goods. Once the goods are completed, they are stored in finished goods. So here's how a manufacturing plant works. We have this raw material inventory. And then, when somebody starts a job, it comes and requisitions material, brings it to this machine, cuts it, and moves it to this machine, and bends it, and over here and laminates it, drills it, and so on. While they're working on all the material, they're transforming the raw material, they're applying labor and overhead and machine costs and what have you to convert raw material to a finished goods. And so when the material is on the floor, it's no longer raw material because it's been worked on. And it's not finished goods, so it's work in progress. And that is the category, an inventory category. So you have raw material inventory, work in process inventory, number 2, and number 3 is finished goods. Now, another important classification of costs here. These are costs, and
here, put my iPad away.
Expenses are costs, but they're not expenses in the same sense as salaries expense on the income statement. These are asset costs. All the costs here in the plant are part of the cost of inventory, so they are called product costs. Those are costs that are reasonable and necessary to convert my raw material into a finished good product. Once the product has been finished and moved to finished goods, that's the end of product costs. We have to distinguish that from period costs. These costs at the front are what are called period costs. They have nothing to do with the manufacture of the product. And they are sales and marketing, general administration, all of those kinds of costs are what are called period costs. They're called period costs because they are going to be expensed in the income statement and the accounting period in which they were incurred. These costs over here, product costs, are not expensed in the income statement until they're sold. So these then become the cost of goods sold when they're sold, but in the meantime, they are the valuation for inventory. And so there you have the distinction, product cost, period cost. Here you have the three different types of inventories for a manufacturing company.